On paper, the silver market looks simple. A price on a screen, bars in a vault, buy, sell, repeat. But in 2020, regulators quietly handed J.P. Morgan a $920 million penalty for manipulating precious metals markets over nearly a decade. That fine did not just expose a few bad trades. It exposed how fragile and how distorted this entire system really is. Today, we have a market where most silver traded never actually changes hands. A handful of banks dominate the flow, and price is often set by algorithms and derivatives long before any physical metal moves. So when you see a chart of silver, you are not just looking at supply and demand. You are looking at a battlefield of high-frequency spoofing, massive paper positions, and institutions with far more information than the average investor will ever see. And here is the disturbing part. The people closest to this system, including J.P. Morgan, have already seen what happens when it breaks, and they have quietly adjusted their own positions, while most retail investors still think this is just another commodity. In this video, we are going to break down how the silver market became so disconnected from reality, what that $920 million fine actually revealed, and why understanding this structure could change how you think about metals, markets, and fair pricing forever. Let's start with the scandal that blew the door open, and what it told us about who really moves the silver price. The story starts with a trading maneuver so blatant it is almost comical. It is called spoofing. Here is how it worked. A trader at a major bank, like J.P. Morgan, would place a massive order to sell silver futures. This was not a real order. They had no intention of actually selling that amount of metal. The sole purpose was to create the illusion of a huge wave of supply hitting the market. Other traders and algorithms would see this massive sell order and react. They would think the price was about to drop, so they would start selling themselves or cancel their buy orders. And this selling pressure would push the price down. At the exact moment the price started falling, the spoofer would cancel their fake sell order and swiftly buy up the cheaper contracts. They manipulated the price down just to buy at a discount. It was a fake-out, executed thousands of times. This wasn't the work of a rogue trader. The Justice Department found this was a coordinated effort spanning 8 years. The sheer scale was staggering. But the real story is the penalty itself. $920 million sounds like a monumental punishment. But for a bank like J.P. Morgan, it is a calculated cost of doing business. It is a speeding ticket for a system designed to run red lights. They made far more from the manipulation than they paid in fines. The case only came to light because of a key whistleblower, a trader who provided the evidence trail. And it took regulators nearly a decade to act. That delay points to a deeper issue: regulatory capture. The people meant to police the market are often outgunned, outfunded, and sometimes too cozy with the institutions they oversee. The fine was an admission of guilt, but it was also a signal. It revealed the game, but it did not change the rules. This brings us to the core of the problem. The silver market, and much of the commodities world, operates on two completely different levels. There is the physical market and the paper market, and they have almost nothing to do with each other. The physical market is what you intuitively understand. It is a mine producing ounces. It is a refinery making bars. It is those bars sitting in a secure vault in London or New York. When you buy a physical silver coin or bar, you are in this market. It is governed by the actual, tangible supply and demand for real metal. The paper market is something else entirely. This is the world of derivatives, futures contracts, options, and unallocated metal accounts. When most traders and large funds talk about trading silver, this is what they mean. They're not buying bars, They're buying paper promises for future delivery. A futures contract is essentially a bet on where the price of silver will be at a future date. The critical and almost unbelievable fact is the ratio between these two markets. For every single ounce of physical silver that exists in registered exchange vaults, there are hundreds of paper claims on it. The market is built on a tiny sliver of real metal, supporting a colossal mountain of paper IOUs. This is how banks create synthetic silver. They can sell promises for metal that does not exist, and may never exist. This system is centralized in places like the London bullion market. When you buy silver through many popular ETFs or trading platforms, you often do not own actual metal. You own a share in a promise. You are a general creditor in a system of unallocated metal. The direct consequence of the paper to physical divide is that the price becomes completely detached from reality. The paper market, with its massive leverage and spoofing, dictates the price for the entire world. The tail wags the dog. A bank in New York can place a fake sell order and move the price of a physical bar sitting in Zurich. This structural flaw is the open secret that makes everything else possible. This system of paper promises does not run itself. It is controlled by a very small group of institutions known as bullion banks. At the very center of this group sits JP Morgan. Their role in this market is a case study in conflict of interest. JP Morgan acts as a market maker for silver. This means they provide liquidity, quoting both buy and sell prices for clients. It is a legitimate function, but their position gives them an unparalleled view of the entire market's order flow. They see the buy and sell orders coming from hedge funds, miners, and retail investors. They have a real-time map of market sentiment and pressure points. You, as an individual investor, see a price chart. They see the engine room. This information asymmetry is a massive advantage. They know where the large stop-loss orders are clustered, the points where a price drop would trigger a cascade of automatic selling. They can see when a large buyer is accumulating a position. This knowledge allows them to position their own trades with a precision that borders on clairvoyance. But the conflict runs deeper. JP Morgan is also one of the world's largest custodians of physical metal. They operate enormous vaults, so they are simultaneously a key player in the paper market that sets the price, and a primary custodian of the physical metal that the paper is supposed to represent. Their incentives are fundamentally misaligned. If the price of physical silver were to rise dramatically due to genuine scarcity, it would be good for their vault business, but it could be disastrous for their massive paper short positions. They are effectively betting against their own custodial assets. This structure insulates them from normal market forces. When retail investors get excited about silver and start buying, they typically buy through exchange-traded funds or futures contracts. They are pouring money into the paper market. The bullion banks, seeing this incoming retail buying pressure, can simply create more paper silver to sell. They can increase the number of IOU claims to meet the demand, effectively neutralizing the upward price pressure. It is a trap. The buying enthusiasm gets absorbed by an ever-expanding supply of paper, leaving the actual price suppressed. The system is designed to maintain control. This control was put to the ultimate test in early 2021. A movement emerged online, with retail investors coordinating to try and break the paper market. The plan was simple in theory. If they could collectively demand physical delivery of silver, they could expose the shortage of real metal behind the mountain of paper. It was a direct assault on the system's weakest point. The reaction was immediate and forceful. Trading volumes spiked to unprecedented levels. The market infrastructure began to strain. Almost instantly, the major trading platforms responded. They did not just raise margin requirements, they effectively shut down the ability to buy certain silver products. They cited market volatility, but the effect was clear. They neutralized the buying pressure. The very mechanisms that are supposed to ensure orderly markets were used to prevent a disorderly upward move. The existing paper structure was the perfect tool for this suppression. Bullion banks could flood the market with additional paper contracts, diluting the buying pressure. Meanwhile, the physical market began to show the true strain. Premiums on physical silver coins and bars skyrocketed. While the paper price on the screen stayed relatively contained, the actual cost to buy a real ounce of silver from a dealer shot up. This created a bizarre, two-tiered market, one price for paper and a much higher price for the real thing. The aftermath of the squeeze was a brutal lesson in the system's resilience. The coordinated retail effort failed to break the price. The paper market held, but it revealed the growing tension. It showed that the system's defenders have powerful tools to maintain the status quo. More importantly, it highlighted the divergence. For those watching closely, the signal was clear. The paper price was becoming less relevant. The real story was playing out in the physical premiums and the withdrawal of metal from exchange vaults. The 2021 squeeze did not change the game, but it showed everyone the playbook. It demonstrated that the market's stability is an illusion maintained by active intervention. The fragility was not gone. It was just being managed, for now. So if the official price is a managed illusion, what signals actually matter? You have to look at the growing divergence. The spot price on your screen is one number. The premium you pay for a physical ounce from a dealer is another. When those two numbers split apart, it tells you the paper market is losing its grip on reality. Watch the wholesale market indicators. The amount of silver leaving major exchanges like COMEX is a critical data point. When registered inventories start falling consistently, it means the physical metal is being claimed. Someone is taking delivery, pulling real bars out of the system that backs all those paper claims. And watch what the banks themselves are doing with physical metal. While they talk down the paper price, they have been accumulating the real thing. They are building their own physical stockpiles, often in non-bank vaults outside the exchange system. Their actions with real metal tell a completely different story than their paper positions suggest. This is the real tension now. The entire paper edifice relies on the belief that you can always exchange your contract for a bar. But that belief is being tested. The gap between the paper price and physical reality is the most important chart to watch. It's the stress fracture in the system. That fracture is the market's defining feature. The $920 million fine was never a cure. It was just the price of admission for playing the game. The structure remains broken by design. If you want to understand these mechanisms more deeply, subscribe for more analysis on the hidden risks in financial markets.